The year 2024 was drawing to a close and many were looking forward to the holidays and a fresh start in the new year. But on Wall Street, a chill wind was blowing. The Federal Reserve, in a move that shocked many analysts, announced that the much-anticipated 2025 interest rate cuts were off the table. The reason? Inflation, that insidious economic bogeyman, was proving more stubborn than anticipated. The markets, accustomed to years of cheap money and easy credit, reacted with predictable panic. The Dow Jones Industrial Average plunged over 800 points on the news, its biggest single-day drop in years. The tech-heavy Nasdaq fared even worse, plummeting by more than 4%, wiping out billions in market capitalization. Investors, caught off guard by the Fed's hawkish stance, scrambled to reassess their portfolios and brace themselves for what many feared would be a prolonged period of market turmoil. The Fed's decision, while unexpected, was not entirely without precedent. Inflation, which had been creeping higher for months, was now at its highest level in over a decade. The Consumer Price Index, a key measure of inflation, had risen by 5.8% in the past year, far exceeding the Fed's target of 2%. The cost of everything from gasoline and groceries to housing and healthcare was rising at an alarming rate, putting a strain on household budgets and threatening to derail the economic recovery. The specter of inflation, once a distant memory from the 1970s, was back with a vengeance. The causes of this resurgence were complex and multifaceted, but several factors were at play. Supply chain disruptions, fueled by the ongoing COVID-19 pandemic and geopolitical tensions, had created shortages of everything from computer chips to coffee beans. This, in turn, had driven up prices as businesses passed on their increased costs to consumers. At the same time, demand for goods and services had surged as the economy reopened and consumers, flush with stimulus checks and pent-up savings, went on a spending spree. This surge in demand, coupled with constrained supply, had created a classic case of too much money chasing too few goods, leading to a sharp rise in prices. The Fed, tasked with maintaining price stability and maximizing employment, was now caught between a rock and a hard place. Cutting interest rates, its usual tool for stimulating the economy, would only add fuel to the inflationary fire. But raising rates too aggressively risked choking off economic growth and potentially triggering a recession. It was a delicate balancing act and the stakes were high. The sudden market downturn, triggered by the Fed's announcement, had many investors experiencing a chilling sense of déjà vu. The dot-com bubble of the late 1990s, the housing bubble of the mid-2000s, the crypto bubble of 2017, all had ended in tears, with investors big and small left licking their wounds. Were we on the cusp of another such bubble bursting? The parallels were certainly there. Years of low interest rates and easy money had inflated asset prices across the board, from stocks and real estate to cryptocurrencies and collectibles. Valuations were stretched, speculation was rampant, and a sense of euphoria pervaded the markets. It was, as the saying goes, different this time. But history, as it often does, had a way of repeating itself. The Fed's decision to tap the brakes on monetary stimulus had exposed the fragility of the market's foundations. The party was over, and the hangover was about to begin. Warren Buffett, the legendary investor and chairman of Berkshire Hathaway, had long been a voice of caution amidst the market exuberance. Known for his value investing philosophy and long-term outlook, Buffett had amassed a fortune by buying undervalued assets and holding them for decades. He was not one to be swayed by short-term market fluctuations or the latest investment fads. In recent years, Buffett had grown increasingly wary of the market's lofty valuations. He had warned of the dangers of excessive speculation and the inevitability of a market correction. Be fearful when others are greedy, and greedy when others are fearful, he famously advised. Buffett's words, often dismissed as the musings of an aging investor out of touch with the modern market, now seemed prophetic. As the market tumbled, investors were left to ponder whether the Oracle of Omaha had been right all along. Section 5. The stock market braces for impact. The stock market, the most visible barometer of the economy, was the first to feel the brunt of the Fed's policy shift. The initial shock of the announcement had given way to a more sobering realization. The era of easy money was over, and a period of volatility lay ahead. Growth stocks, which had soared in recent years on the back of low interest rates, and expectations of continued earnings growth were hit particularly hard. Tech giants like Apple, Amazon, and Microsoft saw their share prices tumble as investors reassessed their growth prospects in a higher interest rate environment. Value stocks, on the other hand, which are typically companies with strong fundamentals and a history of paying dividends, fared relatively better. These companies, often overlooked during bull markets, were now seen as a safe haven amidst the uncertainty. Section 6. Housing market on shaky ground. The housing market, which had been on a tear for the past few years, was also feeling the heat. Mortgage rates, which had hit record lows during the pandemic, were now on the rise, making it more expensive for buyers to finance a home purchase. This, coupled with already sky-high home prices, was putting a damper on demand. Inventory levels, which had been chronically low for months, were starting to tick up as sellers, sensing a shift in the market, rushed to cash in on their gains. This increase in supply, combined with waning demand, was putting downward pressure on prices. The days of bidding wars and all-cash offers were fading into memory. Buyers, now armed with more negotiating power, were no longer willing to overpay for properties. Sellers, faced with the prospect of falling prices, were becoming more willing to negotiate. Section 7. Crypto winter returns. The cryptocurrency market, known for its volatility and speculative nature, was sent into a tailspin by the Fed's announcement. Bitcoin, the world's largest cryptocurrency by market capitalization, plunged below $30,000, its lowest level in months, as investors fled to the relative safety of traditional assets. Other cryptocurrencies, many of which had soared to astronomical heights during the recent bull market, suffered even steeper declines. Ethereum, Solana, Dogecoin, all saw their prices collapse as the air was let out of the crypto bubble. The crypto crash, while painful for investors, was not entirely unexpected. The market had been showing signs of froth for months, with meme coins, NFTs, and other speculative assets proliferating at an alarming rate. The Fed's decision to tighten monetary policy had merely served as the catalyst for a long overdue correction. Section 8. Weathering the storm investment advice for turbulent times. The market turmoil, triggered by the Fed's unexpected announcement, had left many investors feeling anxious and uncertain about the future. What should they do with their money in these turbulent times? The first and most important piece of advice was to stay calm and avoid making rash decisions. Panicking and selling everything was rarely a good strategy. Instead, investors should take a deep breath, assess their risk tolerance, and make sure their portfolios were aligned with their long-term financial goals. Diversification, the age-old investment strategy of not putting all your eggs in one basket, was more important than ever. A well-diversified portfolio, consisting of a mix of stocks, bonds, real estate, and other asset classes, could help cushion the blow of any market downturn. Investors should also consider rebalancing their portfolios, which involved selling assets that had performed well and buying assets that had underperformed. This could help ensure that their portfolios remained aligned with their risk tolerance and investment objectives. Section 9. A call for prudence and perspective. The Federal Reserve's decision to cancel the 2025 interest rate cuts, while initially met with shock and dismay, was a necessary step to combat the growing threat of inflation. The markets, accustomed to years of easy money and complacency, were now being forced to confront a new reality, one marked by higher interest rates, tighter monetary policy, and increased volatility. The road ahead would undoubtedly be bumpy, but it was important to keep things in perspective. Market corrections, while painful in the short term, were a natural part of the economic cycle. They presented opportunities to buy undervalued assets and reposition portfolios for long-term growth. The key was to remain calm, stay informed, and stick to a disciplined investment strategy. Those who did would be well positioned to weather the storm and emerge stronger on the other side. If you're a fan of awesome videos, then you need to hit that subscribe button right now. We've got everything from jaw-dropping moments to laugh-out-loud fun. And guess what? You don't want to miss a single second. So hit that subscribe button and ring the bell to get notified as soon as we drop a new video. Enjoyed this video? Give it a thumbs up and share it with your friends. We want to hear from you too. Got questions, suggestions, or just want to say hi? Drop a comment below. We love chatting with you and your feedback means the world to us. Thanks a ton for watching. See you in the next video.